Why am I not a proponent of active funds versus their index fund peers? That's what we're going to talk about here today on the Heritage Wealth Planning YouTube channel. I was getting in a debate with some folks that I'm part of a financial planning Facebook page, and I was actually pretty stunned about some. It boggled my mind actually how they didn't see the forest for the trees. So we're going to dive into that here today. So if you're an active fund person, feel free to comment down below for sure, because I'm open to them, but you're going to have a hard time convincing me because I've been around this many, many, many times. It's going to have a hard time convincing me. But hey, if you like what you see here at Heritage Wealth Planning, don't forget to subscribe right there. Maybe it's there. I think it's right there. If you do subscribe, hit the notification bell as well so you can be notified of future content. Sorry, just banged the computer. We try to do about 5 videos a week. Actually, we're doing more than that lately just because there's so much going on that I want to talk about. So let's dive right into it. And we're going to start. There's a company called American Funds, and I'm a huge fan of American Funds. They're the Vanguard of the active fund management. And what I mean by that is low turnover, low fees. They charge an upfront commission, all right, and that's not small. It's hefty, 5.5% on, I guess it counts less than 25. I don't know what it is, but if it's less than 25,000, I think it's 5.5%. Whatever. At the end of the day, if you're going to buy a mutual fund and pay a commission, you don't want to pay a commission annually with a fee-based account, 1% or something like that. You want to pay up front and be done with it. I'm just telling you. All these people say commission funds are just wrong. Commission fund, if you pay up front, is much, much more valuable than a 1% annual fee, especially if there's a lot of trading in the portfolio because of taxes. I'll push that off for another day. But that's what American funds do. They say, we are going through financial advisors. Our financial advisors have got to be compensated. It will allow them to be compensated by an annual fee, 1% or whatever, or a front-end commission. However you choose, financial advisor, as long as you disclose it to your client, we're fine with that. And so American funds, really for a long time, probably about to the late 2000s, they had some of the best well-known funds out there. And the one we're going to analyze today is called Growth Fund of America. If I'm not mistaken, in the mid-2000s, it was the biggest fund in the universe, essentially. And now Vanguard is simply taking over that slot and probably never relinquish it. But Growth Fund of America was huge. If you had talked to anybody with an Ed Jones account, broker, any of these guys, thousands and thousands and thousands of people had GFA, Growth Fund of America, as a pretty substantial part of their portfolio. I imagine that's probably not the case anymore, which bothers me because it's a good fund. There's no getting around that. It's a good fund, low cost. If you paid the front end commission, hopefully you kept it. I bet you didn't, which is not good. But anyway, so we're going to dive into why, even though with that said, and again, I like American funds, why I don't even think it's worth it relative to index funds. We're going to dive into it right now. So basically, as I always do, I go to finance.yahoo.com. Been doing that for years. Morningstar gets you a little bit more in depth on portfolio tools in terms of the funds that they have, tax consequence, which you should look at. But just in terms of chart, I've always used Yahoo, and I still like it to this day. It does the job I needed to do. So what we're going to do is we're going to look at the Growth Fund of America, which is this guy here in the darker blue. We're going to look at the Vanguard S&P 500, which is the light blue. We're going to look at the Vanguard Small Cap Index, which is the Russell 2000 in I guess that's purple. And then we're going to look at the Vanguard Total Stock Index in the pink. So we have 4 different funds, 3 of which are Vanguard, and 1 is Growth Fund of America. Now, basically a couple things. The VTSMX, that's the total stock fund. All right, that's a total market fund, excuse me. The total market fund literally is these 2 things combined. All right, so basically the total market fund is about 70 to 75% of the S&P 500. And about 20 to 25% or so of the rest of the funds, the Wilshire 4,500. So you take the bulk in the S&P, which is 500 stocks. You take the rest, the Wilshire 4,500, and that will give you the total stock market index. So the total stock index is all inclusive of all domestic stocks. And right now we're only talking about U.S. stocks. We're not talking about anything international, and we're not talking about bonds. The Growth Fund of America will have a large cap growth proportion to it. Now, they do go to the mid caps and probably even some small caps in there, but generally speaking, on the quadrant of growth versus value, large cap versus small cap, they're going to be on the high large cap growth area, whereas the VTMSX in particular is kind of spread out across the quadrant, or I guess it's 9 boxes. I don't even know what you call 9, the nidrant. So at the end of the day, the VTS SMX is going to be much more diversified than the Growth Fund of America. And there's a reason I'm showing that to you. The S&P 500 is going to be not just growth, it's predominantly growth. About 65% of the S&P 500 is growth stocks and about 35% is value stocks, but a little bit more diversified in the S&P 500 as well. And just so I'm not trying to cherry pick here, at the end of the day, I just want to be clear. The Growth Fund of America has an exclusive sliver of their portfolio. Again, it's more the growth side of the coin. That's all there is to it. The S&P 500 is the large cap, intermittent, commingled between growth and value. And then, of course, small caps are small, and VTMSX is about 25% small to mid stocks and about 75% large. All right, so I just don't want you to think I'm cherry picking here because I'm just showing this for an example. The Growth Fund of America was the biggest large cap fund. I don't even think just large cap. I think it literally was the largest fund for a long time in the world. Previous to that was Fidelity Magellan, and that's fallen on tough times. I mean, we had these lists of various funds that were the biggest and best, and they simply couldn't compete against the indexes after a while. And, basically what happens is if you can't beat them, join them. And that's where the industry is today. So we're going to go back. I just want to go back 20 years, so January to 1998 till June of 2018, just to start this tutorial here. And again, as you see, the Growth Fund and the S&P are down here. So they've returned 183% respectively. I think Growth Fund of America did a little bit better than the S&P 500. And the only reason I said 1998 till today is because it's 20 years. I mean, it's nothing fancy there. I don't literally go back to 1997. I don't care. It's just at the end of the day, the S&P 500 and the Growth Fund were kind of neck and neck. This is the small cap index, which is up 230, which smoked both of them. And then because the small cap index is a portion of the total stock index, that came in second at 208. So it is pretty significant. I mean, 50% above, 25% above. But at the end of the day, the Growth Fund of America and the S&P were just neck and neck, and that's going to be net of fees and net of any commissions paid. It will not be net of taxes due, and I do want to dive into that here as well. But so for 20 years, Growth Fund of America and S&P were hand in hand. Looks like the Growth Fund did a little bit better, and then it got smoked. Both those got smoked by small and then total stock indexes, which would make sense because that's where the diversification can really play. But I don't really care so much about that. I do want to show you something. This is actually where my argument with these guys today kind of ticked me off a little bit, because you got to go back to 2000. And then we're going to go to 3/9/2009. And I was stunned. I just stunned how these guys didn't get the significance of these dates. All right, so what I want to show you here, on 1 January 2000, the markets proceeded to get killed. It went all the way down, and this is the S&P 500. Went down 9% in 2000. 11% in 2001, 22% in 2002, had a little bit of a dead cat bounce actually in October of 2002, and then it fell again and going into March of 2003. But basically, at the end of the day, the first 3 years of this millennia, the S&P 500 got hammered. There's no getting around that. Absolutely. And we remember that because that was a tech boom and all that, and then the tech decline. Now, we had a decent return from basically February, March 2003 up until October 2007, when the Lehman Brothers debacle took over and everyone just got hammered again until March 2009. I got March 2nd there. I want March 9th, 2009 is, there it is. March, why is it doing March 9th? March 9th, let's do 10. Will that give us the... pretty close. It won't quite give us the bottom. I guess it does it by month. But anyway, that's fine. At the end of the day, March 9th of 2009 was when the market bottomed out for the final time in the modern era of the century. All right, so I want to show you performance because the argument always is active management outperforms indexes in a down market. And the reason for that is active managers can do things in terms of getting out of the market, get back in, put money in cash, put money over here, put money there, whereas indices can't. An index has got to mimic the index, which is going to be 100% invested in stocks. No cash in an index fund, because that inherently would make it actively managed. It needs to have 100% exposure to the 100% stocks that are in the indice, be it the S&P 500, the Russell 2000, or whatnot. So remember, the argument is that in down markets, active management shines the best. So let's just take a look if that's true. Again, this is the Growth Fund of America, the largest, most talked about, the biggest fund that was out there. Everyone was sweating the Growth Fund of America. I remember like it was yesterday. Growth Fund of America, man, everyone wanted it. And let's see what happens. So Growth Fund of America, that's the dark blue, was down 32%. And from 1 January 2000 to March of 2009, S&P 500 was down about, 37%. So the S&P 500 was a little bit down below the Growth Fund of America. Russell 2000 was down only 10% during that time. And then the total stock index was down right about, that was down about 31%. So the total stock index, 28%. Is that what it says? Yeah, 28%. So the total stock index was down 28, which beat the Growth Fund of America, and the Growth Fund of America squeaked out a little bit of a gain relative to the S&P 500. So at the end of the day, again, diversification, the small caps, while you still were down 10% for basically that decade, you weren't nearly as far down as the S&P 500 or the Growth Fund of America. But that's not the argument. The argument is that during down markets, active fund is supposed to protect you from significant losses because they have some intuition about when the markets are going to decline, that they can get you out, they can put you in cash and all that. And this simply didn't happen. Growth Fund of America is part and parcel of an active managed fund. There's just no getting around that. And American funds are wonderful, actively managed funds. There's no getting around that. You're not going to beat a better active management shop than American funds. You're just not, especially the fees and the low turnover. So if American funds can't beat, I guess they beat just a little bit, but not anything to write home about in terms of the S&P 500, your argument about active management giving you downside risk protection in market declines is simply not there, because it was still down 32%. Of course, the insinuation is, the active management fund shouldn't even come anywhere near that 30% decline, maybe 10% or something like that. And it's just simply not true. All right, so now we're going to go to October 2007. And I guess it only does month by month. So we're going to start October 2007 and to March of 2009, because that was when the Lehman Brothers thing hammered us. And let's see what growth. So again, you can see here's Growth Fund of America was down. Let's see, it's hard to see. They're all right in a bunch there. So Growth Fund of America is down 51%. Small cap was down 53%. I can't really tell. Let's see. So we got, I can't tell. It's hard to see. Can I make it bigger? I don't know. But anyway, at the end of the day, they're all basically right there. We have small cap now 53, Growth Fund America now 51. I can't see what that pink guy is doing, but it looks like a little bit better than Growth Fund America. So and it looks like the S&P did a little bit better than the Growth Fund America, but all bunching right there. At the end of the day, they're all down 50%. Don't get around that. It's down 50%. And again, small caps, large caps, everything was down 50% from October 2007 to March 9th of 2009. And again, this is the time where active management funds are supposed to outperform. And there's just no evidence of that, none whatsoever. And so what they'll say is, well, and we'll give up that active management can't outperform the up market because we keep cash. We're a little bit more conservative, a little bit more protecting against the bottom line, but we do on the down. And it's just, there's no evidence of that whatsoever. And again, I'm using this one fund as my anecdotal evidence, but it's anecdotal evidence nonetheless. It's good evidence to look at. So now let's just go to March 10th of 2009. And this is when the market started taking off. All right, so March 9th, 10th of 2009, let's go to the end of today. And this is when the up market is. So remember, active management is supposed to give us downside risk protection, even if they allow outside growth in the up markets. That's supposed to happen. Now, look at this. This is sickening. So from 2009 until today, here's a Growth Fund America is up 150%, which it's not that bad. I'm not saying it's bad. But here's small cap is up almost twice that. Here's a total stock market index is up about 50%. And here's S&P 500. It's just not even debatable. So on the upside, the active management underperformed. On the downside, it similarly performed. That's the message to be learned here. If we just look at since 2001, if we just go back to the beginning of January of the first month of the decade of this millennia, and we say what did better over this 2 time frames of up and down markets, it's not even close. Look at that. I mean, so from from January 2000 till June of 2018, small caps did. I mean, that's almost 3 times better than the Growth Fund of America. The total stock market did, I said, 50% better than the Growth Fund of America, and the S&P 500 did about 20% better than the Growth Fund of America. And that's before taxes. And again, that's down and up. So we just showed you proof. The down markets, Growth Fund of America, the active fund, did not do any better than the non-managed funds, non-active funds. Up markets got swamped. I don't know how you argue against this. And people say, well, so anyway, the issue is these guys are saying you're cherry picking the dates. Absolutely not. The reason why March 9th, 2009 is so specific and significant is that is the bottom of the market. So that was when the market, literally, you can make these analysis almost you cannot hardly get any better in terms of analyses of when markets decline, because from October of 2007 to March of 2009, that was the biggest drop we've seen, literally a 50% drop since the Great Depression. You can't get any clear. And there's only one asset class that did anything that time was government bonds. So you literally could not get any better as a way to evaluate performance of active managers. You just can't. Now, on the other hand, on the upside, we've had a boom market like we haven't seen for a long, long time. We haven't had anything in terms of a bear market. We haven't had any. Now, small caps and international stocks have had a tiny bear market. Back in 2016, they were down 20% for a little bit of time, but not much. And they've since jumped, come back off the mat. Right there, 2016. There you go. That's small caps, the purple. But we've had nothing of any sort of any kind of bear market for the last, going on 10 years now. So you have up market, we can see how active management underperformed. We have down market, we can see how active management is similar to performed. I mean, the proof is right there in the pudding. So now I want to show you something else. Let's see. I'm going to go to Morningstar. Or wait, I want to show you the taxes too. So let's see if we go to, I wonder if this will give us a taxes on this guy. So let's go to summary, because this is what I want to show you too. Profile. Because what happens with active management, because they're actively trading, they're generating more tax consequences as well. And so you have a turnover like 2% in the S&P 500, which means it has 100 stocks. Only 2 of those 100 get sold every year, which means their portfolio is not generating much taxes at all, because they just buy an actively managed fund. You have a much higher turnover, which is going to be more tax for sure. And let's see here if they show us any kind of taxes on this page. Where would I want to go? Maybe let's go to performance. Let's just go to Morningstar. Hold on a second. I'm going to pause this for a second. I'll be right back. All right, my friends, so I'm back. And so now we're at Morningstar.com. And for some reason, Morningstar takes forever to load on my system. It drives me up the wall, actually. So what I want to show you is that with Morningstar, we can actually look at the tax ramifications of an actively managed fund. And I've done this before in previous videos, so you can certainly go back and check them. But look, look at that. Potential capital gain exposure on American funds is 51%, which means over half the portfolio, if they sold the entirety of the portfolio and you had $100,000 in, you'd have a $51,000 capital gain tax. That's pretty significant. So what we want to see here is since inception, the pre-tax return is 13.75. Tax adjusted return is 12%. So it's lost 1.73% a year. Let's see, do I have my trusty old calculator? Hold on, right here. So 1.73% a year, 1.73 divided by 13.75. So it's about 12.5% is what it loses in taxes in terms of return. So if it loses 12.5% to taxes of its total return. And you can see 15 years, they lost 1.36 or something like that. Here, you can see. So here's a pre-tax, here's a net tax right there. So that's a tax adjusted return. That's pretty significant, actually. In fact, I think this is what this shows you is total cost ratio, how much of the return is costing. Actually, I don't know what that is. I got to dive into that. Anyway, but at the end of the day, that's all that matters. What'd you get pre-tax? What'd you get net tax? All I care about is net tax. So that's 12 0.58% return with a significant capital gain exposure. And that's good. That just means they don't trade a lot of stocks, but at some point, someone's paying that tax for sure. So let's go to Vanguard S&P 500 and see what that is right there. So we're losing we're losing a pretty significant amount of money. 1/8 of our total portfolio performance to taxes with the American Funds Growth Fund of America. Let's see what the S&P 500 does. It's a lot. Look at that. Still pretty high capital gain exposure, and that's just because of the market. We've had a big market last going on 10 years. But here, since inception, 11.05, and divide that by 9.57. 1.48 divided by 11.05. Still pretty big. I mean, that's actually even more than the Growth Fund of America since inception. But you can see it's starting to dwindle quite a bit for the last 15 years, with 9.17 minus 8.71 divided by 9.17. So, I mean, here they're losing 0.5% over the 15 years. So they're definitely in a much, much better tax cost rate. And I don't know what that is. I have to dive into that. But at the end of the day, so obviously the S&P 500 has some big tax consequences before. Over the last 15 years, those tax consequences have been minimized for sure to represent about 5% of the overall portfolio, where the Growth Fund of America was about 12.5%. Actually, but that's not fair. I want to see about Growth Fund of America for 15 years. There you go. So you got 10.44 minus 9.08 divided by 10.44. Yeah, so it's still about 13%. So since inception, don't forget, the S&P 500 has been around since 1974, 73, I think 1973. So that's a tough one to use there. So over 15 years, Vanguard loses 5% of its return to taxes. American funds lose about 13% of return to taxes, and American funds is actually quite frugal and stingy when it comes to actually buying and selling stuff. It's just not very aggressive, and that's why I like it. Low expenses, low turnover, good performance. But at the end of the day, the numbers are the numbers. You get less taxes, less fees, and better performance in the S&P 500. It's just, there is no getting around that. I just don't know how you'd argue that any differently. And yes, are we cherry picking the dates? No. I mean, October 2007 to March 2009 is a very specific, significant time in the stock market history. 1/1/2000 till 3/9/2009 is another very significant one, because we had a huge down, capture some of the up, and then a huge another down again, like a roller coaster. And then 3/10/2009 to today is another significant one, because it's been all up. So you cannot get a better time frame to analyze stuff. So just want to share that with you. It's just, I'm sure there is an active management fund that would say, well, we did better during those time frames. I mean, if you know it, put it in there. Let's see. I mean, it's just, those are the time frames to look at that you should analyze for everything. The downside risk, how much it got hammered during downside risk times. And then secondly, how much is the upside capture? I mean, the numbers are the numbers, and you just can't get around that. So the representative of active management, the Growth Fund of America, it doesn't hold the water. I'd love to hear other funds that do. And I'd love to see that you were able to pick those other funds in advance, because that's the second thing. You can say at the end of the day, well, this fund did well. Okay. Did it do well on all these occasions like the index funds typically do? And the answer is probably not. So I hope you find this of interest. And again, I'm open for debate. I'm open for discussion. Just steer me wrong. I'll be welcome to hear that. So if you like what you see here, again, subscribe down below. Don't forget to hit the bell to be notified of future content. As always, comments. My goodness, comment. I love to hear them, good, bad, or otherwise. I don't care. And a thumbs up are always helpful as well. So we'll see you next time on the Heritage. Oh, and by the way, what was I getting ready to say? Oh, so the whole premise of this YouTube video is I did it on my email list. I just sent to my subscribers on my email list another kind of topic on this, which is what made me prompt me to do the YouTube video. So if you want to subscribe to my email list, just go to heritagewealthplanning.com. heritagewealthplanning.com will be a sign up right there. So and I try to send 3 emails or so a week as well. So if you want to be good on that, just go there and sign up. We'll see you next time. Thanks, guys.